President Donald Trump launched what would become one of the most significant trade policy shifts in recent American history. It marked the beginning of a trade war that would reshape global commerce and affect billions of dollars in goods. The GDP growth warnings. As the tariffs escalated through 2018 and 2019, economic forecasters delivered increasingly dire predictions about China's growth prospects. Multiple analyses using computational general equilibrium models projected China would see GDP decline of around 1%. While this might seem modest, for an economy as large as China's, it represented hundreds of billions of dollars in lost economic activity. Major news outlets and economic research institutions documented what they expected to be a significant contraction in Chinese consumer spending as tariffs bit into economic confidence and household incomes. The technology sector faced particular vulnerability. Electronics, telecommunications equipment, and data processing machines formed the backbone of China's export economy to the United States, and these sectors were directly in the crosshairs of the tariff policy. China's massive textile and consumer goods industries, which had long supplied American retailers with everything from clothing to household items, faced significant tariff increases. Economic analysts projected that U.S. importers would reduce orders from China, leading to factory closures and massive job losses in Chinese manufacturing hubs. The golden age of U.S.-China trade. For nearly 2 decades before 2018, goods moved with remarkable ease between China and the United States, creating one of the most consequential economic relationships in modern history. This era of relatively open trade transformed both economies and reshaped global commerce in ways that are still being felt today. Just before the tariffs hit, China is America's largest source of imports, accounting for more than 21% of all goods coming into the United States. The trade relationship had grown so massive that the U.S. trade with China reached over $375 billion yearly. The Great Trade Diversion. When Trump's tariffs on Chinese goods took effect in 2018 and 2019, something remarkable happened. Rather than crippling Chinese exports to the United States as intended, the tariffs triggered one of the largest redirections of global trade flows in modern economic history. The pathway that emerged was simple, yet sophisticated. Goods that once flowed directly from China to the United States now took a detour through Mexico, often with little more than a label change to mark the difference. This wasn't a minor adjustment, it was a massive reshaping of North American trade that would see Mexico surge past China to become America's top trading partner, while Chinese goods continued flowing into the United States, just wearing different packaging. Chinese companies didn't stop selling, they just moved the final assembly next door. The mechanics of rerouting. The rerouting strategy came in several distinct forms, each designed to exploit different aspects of trade law and tariff regulations. White labeling and entrepot trade. The most common method was what trade analysts call white labeling or entrepot trade. Chinese companies, sometimes in partnership with American importers, desperate to avoid the steep tariffs, established facilities in Mexico. These weren't always full-scale manufacturing plants. Sometimes they were little more than warehouses where Chinese-made goods arrived, were repackaged, relabeled as made in Mexico, and then shipped across the border into the United States. The beauty of this strategy, from the perspective of those using it, was its simplicity. A product manufactured entirely in Shenzhen could arrive in Tijuana, spend a few days in a Mexican facility, get new documentation listing Mexico as the country of origin, and cross into California completely tariff-free under USMCA rules, or with tariffs dramatically lower than the 25% rates that direct Chinese imports faced. Transshipment through third countries. Vietnam became another major transshipment hub, though Mexico's proximity to the United States made it the preferred route for many goods. The data told a striking story. The value of Vietnam's exports to the United States almost perfectly matched Vietnamese imports from China in recent years. This wasn't a coincidence. Chinese manufacturers were shipping goods to Vietnam, where they underwent minimal processing or simple repackaging before being exported to the United States as Vietnamese products. For Mexico, the pattern was similar, but even more pronounced because of its unique advantages: immediate proximity to the United States, membership in the USMCA, which guaranteed preferential access to American markets, and a long-established infrastructure of cross-border trade. Please subscribe and like for more world news and updates. The currency weapon. When President Trump began imposing tariffs on Chinese goods in 2018, China's central bank had a powerful tool at its disposal: the exchange rate. China's strategic use of currency devaluation would prove to be one of its most effective weapons against American tariffs, effectively neutralizing much of their economic impact, but at considerable risk. The mechanics of the strategy. When the United States imposed tariffs on Chinese goods, those tariffs raised the dollar price that American importers and consumers had to pay. A 10% tariff, for instance, would typically translate into a 10% price increase, reducing demand for the Chinese product. But if China's currency, the yuan, weakened by approximately the same amount as the tariff, something remarkable happened. The higher tariff cost was offset by the lower currency value. American importers would still face similar prices in dollars, which helped stabilize demand for Chinese products. The devaluation essentially canceled out the tariff's intended effect. The enormous risks of devaluation. While currency devaluation helped China offset American tariffs, the strategy carried substantial risks that constrained how aggressively Beijing could deploy it. Import cost inflation. Devaluation also carried a direct cost to the Chinese economy through higher import prices. China imports $1.731 trillion worth of goods, not far behind the U.S. total. Higher local renminbi import costs could also conceivably trigger inflation. This was particularly problematic because China is a major importer of essential commodities: oil, natural gas, soybeans, industrial materials, and high-tech components. As the yuan weakened, all of these imports became more expensive in yuan terms, potentially squeezing Chinese manufacturers and consumers. The strategic pivot. When the United States imposed tariffs on Chinese goods starting in 2018, China faced what economists call a massive negative demand shock. American consumers and businesses, who had been buying over $500 billion worth of Chinese goods annually, suddenly faced 25% tariffs that made those products more expensive. The conventional wisdom suggested this would devastate Chinese exports and force a fundamental restructuring of the Chinese economy, but something remarkable happened instead. Rather than collapsing, Chinese trade simply redirected. The tariffs created a challenge, yes, but they also created an opportunity that Chinese policymakers seized with both hands. Within just a few years, China had dramatically deepened its economic relationships with three major markets: ASEAN in Southeast Asia, the European Union, and Africa. From 2017 to 2022, ASEAN's imports from China rose by a staggering 70%, reaching $432 billion. More than 80% of these imports comprised electronics, machinery, chemicals, plastics, aluminum, and other industrial goods, exactly the categories that had been hit hardest by U.S. tariffs. The European Union connection. While ASEAN absorbed much of the attention, China's trade relationship with the European Union also experienced significant growth in the wake of the U.S. tariffs, though the dynamics were more complex. The products that Americans had stopped buying were finding eager buyers in European markets. In 2019, China's exports to the EU reached record highs. The African dimension. Africa represented a different kind of opportunity for China, not primarily as a market for finished goods, but as a source of raw materials and a destination for infrastructure investment that would facilitate long-term trade growth. The Belt and Road infrastructure. These weren't entirely new partnerships. China had been trading with all three regions for decades, but the 2018-2019 trade war accelerated and intensified these relationships in ways that fundamentally reshaped global trade patterns. How China developed its own industries against USA tariffs, from crisis to opportunity. The tariffs exposed China's vulnerabilities, its dependence on foreign technology and critical sectors, its reliance on American markets, and the fragility of supply chains that could be disrupted by political decisions. But rather than accept defeat, China transformed this crisis into an unprecedented opportunity for industrial development. The response was comprehensive, ambitious, and backed by resources that few nations could mobilize. China didn't just try to work around the tariffs, it launched a systematic campaign to develop domestic capabilities in the exact industries where it was most vulnerable: solar panels, semiconductors, artificial intelligence, electric vehicles. These became the battlegrounds where China would prove it could not only compete, but potentially dominate. China's photovoltaic capacity crossed the 1 terawatt threshold in May 2025 and surpassed 1,100 gigawatts by June 2025. To put this in perspective, China's solar capacity installation in a single year was larger than most countries' total cumulative capacity built over decades. Semiconductors, the fight for technological independence. If solar panels represented China's greatest industrial success, semiconductors represented its greatest challenge and vulnerability. Chinese firms imported more semiconductors than any other product. Chinese companies could produce chips at 28 nanometers and above, but cutting-edge chips at 7 nanometers and below, essential for AI, advanced computing, and military applications, the United States weaponized with strategists called choke points, single points of failure that could shut down entire industries. The weapon of choice was ASML's extreme ultraviolet lithography machines, the only equipment capable of manufacturing chips below 7 nanometers at scale. Chinese analysts identified specific choke point technologies, including both semiconductors and the photolithography machines needed to manufacture them. The long-term bet. China's semiconductor investment defied normal economics. Many projects made no financial sense based on traditional ROI calculations, but Beijing treated semiconductor development as a matter of national survival rather than a business plan focused on profitability. This was a calculated bet that these investments would elevate China to become one of the few players capable of end-to-end semiconductor manufacturing. Even if China couldn't match the most advanced nodes, dominating mature node production and achieving self-sufficiency in a broader range of chips would reduce strategic vulnerability. The adaptation playbook. While American policymakers assumed tariffs would force China to capitulate, Beijing had different ideas. Tariffs and technology restrictions accelerated exactly the Chinese industrial development they were meant to prevent. By creating existential threats to Chinese access to semiconductors, artificial intelligence, and other critical technologies, the United States gave Beijing both the motivation and political justification for massive industrial policy investments. Without the trade war, China's semiconductor industry might have continued its gradual development, remaining dependent on foreign suppliers for advanced chips and equipment. Please subscribe and like for more world news and updates.